Consumer credit card debt is absolutely exploding higher, now over $5 trillion, and personal interest payments just hit a record high. The consumer debt picture also indicates that decades ago, there was a massive structural break in the economy and the broader financial system. Will we ever recover? So, remember, two important caveats before we look at the data. Private banks create the vast majority of dollars in the system. Private banks print about 85 to 90% of all the dollars in the system. If you're not familiar with Richard Werner's private bank credit creation theory, I will link videos at the end that go into more detail about that. But about 85 to 90% of all dollars in the system were created by a private bank. When they extend a loan, they are printing money. It is your liability, it is their asset, whether it be a credit card, an auto loan, or a mortgage. It is their asset, it is your liability. And by extending that loan, they're creating money, they're printing money. Point number one. Point number two, one man's liability is another man's asset. So it is two sides of the same coin. You can either think about this as credit or debt. Now, first, we're going to look at revolving credit and the percent change from last month. We can see credit card debt, or again, credit, depending on how you want to look at it, grew by 9.7%. Now, the 12-month average there is 3%. If we look at consumer credit, the nominal change, consumer credit or debt grew by $16 billion just month over month. Now, the 12-month average there is about $10.3 billion per month. Home equity lines of credit also grew, but they are growing at 5.2%. So, of course, boomers and Gen X that were able to buy a home, say in the 70s, 80s, 90s, 2000s, they are sitting on huge amounts of untapped wealth due to the appreciation of real estate. Well, one way to tap that is with a HELOC or a home equity line of credit. We can see that those currently stand $271 billion and are growing at about 5.2% annual growth rate. Here for auto loans, these stand at $1.66 trillion. The quarterly change here, this is not reported monthly, but quarterly change, 1.2% growth in auto debt. The annual average is a very anemic 0.5%. Now, to get into the massive structural change, here is the first slide we're going to look at. So here we're looking at loans and leases. Remember, private banks create the vast majority of dollars in the system. We're looking at the balance, the absolute balance of all of those loans and leases combined, currently $13 trillion. If we think of it as total commercial bank credit, just another way to measure a similar concept, that stands at $18.7 trillion. And you can see the correlation between the two is almost 1-to-1, just different ways of measuring it. Well, we can see a very, very clear trend here from the 70s and 80s up until 2008, when, of course, this broke down. And we can see that the gap here for loans and leases corresponds to about $10 trillion. And for total commercial bank credit, that gap stands at about $20 trillion of unrealized credit, or put another way, unrealized debt. Now, down here, why this matters, here we are looking at the correlation between GDP with a 6-month lag, right? So pushing GDP 6 months forward, and of course, the rate of change of total commercial bank credit or loans and leases. Again, very similar ways of measuring the same concept. And we can see that as private banks, again, responsible for 85 to 90% of all money in the system, originally came from a private bank, we can see that when they start to extend more loans, that corresponds to GDP with a very, very strong correlation. Again, GDP comes about 6 months later after they extend those loans. So here we're looking at consumer credit. And again, you can see that there was a very, very clear trend going all the way back to 1950, all the way up to either 1990 or 2008. There were kind of two trend changes here. 1990 savings and loan crisis was one of the first kind of breaks where private banks started to step away and not extend as many loans anymore. But then 2008 was a really, really large one. We can see the gap here, 12 trillion to 5 trillion. That's about $7 trillion as measured by consumer credit that has been unrealized. Now, there's a unit error with this data set. Divide by 1,000 is actually $5 trillion. If we look, again, GDP, given that private banks create the vast majority of dollars, it makes sense that GDP is tightly correlated. And we can see that 4 year correlation coefficient almost a perfect 1 to 1, except in the end of 2005 and definitely by 2006, the correlation was breaking down significantly. Now, not only that, but real estate loans very, very tightly correlated to GDP, as we can see here. And again, very, very clear trend from 1950 all the way up until 2008, where this gap represents about $20 trillion of unrealized credit, or put another way, unrealized debt. So it makes you wonder how much GDP we would be getting if the private banks were loaning out money at the rate that they were from 1950 all the way till 2008. Of course, we can see this also reflected by the M2 money supply in logarithmic form. This is the broad money. Remember that there's two main ways of measuring the money supply: narrow money, or monetary base, which is M0, that is currency in circulation created by the mint, and bank reserves, which are created by the Fed, that is M0. M2 starts to include much more broad ways of measuring dollars, like demand deposits, checking accounts, right, savings accounts, CD accounts, those sorts of things are included in M2. And so a much broader way of measuring the money supply. This, you can see that private bank credit creation here in the M2. You don't see it in M0 because, again, M0 is just official government money. It is just currency created by the mint or the treasury, and bank reserves, which are created by the Fed. So when it comes to private bank credit creation, that you see that in M2, not in M0. M0 is kind of official money you can think of. Well, the annual rate of change for M2 is running at about 5% annual growth rate. But again, look at the huge drop off that we had here in 1991. And you can see the difference here. That is $55 trillion. M2 is only at 22 trillion. So if we had kept pace with the growth rate from 1950 all the way up until 1990, that 40-year period where, of course, America was quite strong, that equates to about $30 trillion of unrealized M2. Now, here's a look at the interest rate. So by definition, America overconsumes. We are a twin deficit country. So fiscal deficit, meaning the government spends more money than it collects in revenue, fiscal deficit, and current account deficit, mainly due to a massive, massive trade deficit. So that we run a twin deficit. And by definition, we are not productive. Well, how do we finance all of that unproductive spending? Well, we do it by taking on debt. The only asset that a twin deficit nation can accumulate is debt. And sure enough, the cost of the debt, the interest rate on that debt, was falling all the way from 1980 up until a couple of years ago. The cost of the debt was falling. So we were able to take on more and more debt, whether it was the government or whether it was private, average Americans, consumers. Everyone was able to take on more and more debt and fuel that overconsumption because the cost of the debt was falling. Well, of course, we know what happened. We broke out of that 50-year trend here about a year ago, and interest rates are much higher, but credit card interest rates are even worse, 22%. Now, you might be wondering about delinquencies. Those are currently at 3%. This is the credit card delinquency rate, currently 3%, notably above the pre-2020 level down here at about 2.2%. So delinquencies are going up as interest rates are going up. Now, here is the personal interest payments, currently $571 billion. Remember, you are paying that money to a bank. A bank is making, on all the personal interest payments, just on the interest side, they are making $571 billion per year. Now, the per capita, per person in the labor force, that works out to about 3.3 thousand per person per year. And if we look using the average hourly wage as a denominator, this tells us how many hours of work must the average American work per year just to pay the interest on all of their debt. Well, that number is about 107 hours per year per person that must be worked just to pay the interest. Nothing about the principal, not paying down the balance, but just the interest side. And we can see that we have gotten to this kind of range up here twice before. And both times a recession followed. So I think this yellow line is a much better way of looking at the real debt burden for the average American. Now, getting back to the structural change, we know from looking at the prior slides that private banks create the vast majority of money in the system. That is very correlated to real actual GDP, real economic output. And we know that they stepped away either in 1990 or in 2008, depending on the metric that you look at. We know that the party that was creating 90% of all the money, we can see, of course, the correlation between these. That party, those private banks stepped away. Well, something had to fill its place. But before we get to that, I want to show there's a number of metrics I could show for this particular concept, but these are two, I think, really, really good ways of illustrating it. We also have the labor force participation rate, which peaked in the mid to late 90s here in purple. And we have the real purchasing power of personal income as a share of M2, which, of course, personal income was growing for the average American faster than the money supply was from the 70s all the way out, really the 60s, all the way up until the mid to late 90s. And of course, ever since has been declining. What that means is that M2 money supply has been growing faster than personal income since 1990. The real purchasing power of your personal income has been falling as the labor force participation rate has also been falling. Now, there's other ways of calculating this, by the way, that show an even lower labor force participation rate. The Shadow Stats has one that is even lower than what the government metric is. But something had to fill its place. So we know private banks stepped away. We know that we can see the kind of real economy, the average American, has been getting poorer for the past 25 years. We can see that reflected in the labor force participation rate, personal income as a share of M2, both of which peaked in the mid to late 90s and have been falling. We know private banks, which drove GDP, the correlation there very, very tight, almost a perfect one-to-one correlation. Well, those private banks have stepped away from printing money or extending new loans. Well, something had to fill its place. What was it? It was two things. So here we're looking in white at M0 money. This is official government money divided by broad money. So official government money divided by private bank money. You can see the relative growth rate. M0, again, currency in circulation and bank reserves created by the Federal Reserve, started to grow massively faster than the broader money supply here in 2008, more than doubling as a share of the M2 money supply from about 11% to 26%. So what this means, the government, through both currency in circulation, which is the Treasury Department, the Mint, and the Federal Reserve, which is, of course, they print bank reserves out of thin air, and they use those to purchase assets. That is what QE is, but it creates M0. M2 reflects what are the private banks doing? Well, we can see that, again, the official government money started to increase far, far, far faster to fill the gap than the broader money, the private bank side of kind of the money supply. M2 as a share of GDP, well, this is another way of thinking about it or illustrating kind of a similar concept, which is we can see that we started to try to print for prosperity. We can see that M2 as a share of GDP here in 2005 was about 50%. Well, we can see M2 started to grow at a much faster rate than GDP, now currently at 73% relative share. So this is what filled the gap. We know, again, private banks create the vast majority of dollars. We know that they stepped away either in the early 1990s or certainly by 2008. We know that this equates to a massive amount of untapped wealth for one person or debt for another person, $20 trillion. And of course, we know that that has a very, very strong correlation, almost perfect correlation to GDP. So it makes you wonder, what would GDP be if the private banks were keeping their credit growth or the average American's debt growth? If that had kept pace from 1950 all the way up till 2008, it makes you wonder what the world would look like. Clearly something broke, and we know what stepped in to fill the gap. The average American's personal income has less and less purchasing power. The real economy, the average American, that economy has been slowly dying, as we can see by the labor force participation rate and real personal income. We can see both of those have been falling. Well, something had to come in to fill the gap. And of course, this is also when the debt, federal debt held by Federal Reserve banks started to skyrocket as well. And there are issues with on the debt side. If you look at foreign held debt as a share of U.S. government debt, that peaked very shortly after 2008, right here in the early 2010s. So there were a number of kind of massive structural changes in the past couple decades. And it makes you wonder what the American economy, what the average American's life would look like if these structural changes hadn't happened. We can see that they are trying to print their way to prosperity via the M2 to GDP, and we can see M0 to M2. We can see that that official government money, which was keeping relative pace with M2 growth, of course, the break here in 2008, everything changed. M0 went from about 11% of M2 all the way up to 26%, more than doubling. So, anyways, hopefully that was helpful. This will be something to keep an eye on. Again, both two times that this happened, that it reached 110 hours of work per person to service the various debts and pay the interest. Both times we crossed over 110 hours, we had a recession. So we'll have to continue to watch. But again, M2 is growing at 5% annual growth rate. If you look across credit creation, kind of broadly speaking, real estate loans are growing at about 1.8% annual growth rate. M2 is growing at about 5%. We know the consumer is starting to get tapped, and tapping revolving credit or credit cards. Of course, this skyrocketing by 9.6% month over month. And we also know home equity lines of credit. That is another way that consumers, average Americans, are digging to find money to come up with. We know the median American is getting quite squeezed. So this can be expected to go up. And of course, as that debt burden gets worse, we should expect the delinquency rate to probably also go up. So anyways, hopefully that was helpful, and I'll catch you on the next one.